Hello everyone, my name is Anna and we're Dania Accounting. Today we're delving into the audit requirements in Denmark for annual reports. Whether you are running a small startup or a large corporation, understanding these requirements is key to ensuring your business stays compliant and thrives. We will break down the regulations whose affected by audit requirements and what steps you need to take. Stay tuned as we navigate through the Danish audit requirements together. Audits of annual reports are not mandatory for most companies in Denmark. In general, larger limited liability companies need to be audited, and smaller companies don't need to be audited. The difference between smaller and larger is defined by thresholds for revenue, amount of employees and assets. Also, it is worth noting that new audit rules was introduced in Denmark in 2023. From the 1st of January 2023, the audit rules was extended to include smaller companies in so-called high-risk industries. If a company operates in one of these high-risk industries with a revenue of more than 5 million Danish crowns per year in 2 consecutive years, it will need a statement from an auditor in the annual report. You will find a list of the high-risk industries in our blog on www.daniaaccounting.com. A statement from an auditor doesn't mean a full audit, but additional costs for an auditor statement should be expected. Furthermore, companies with assets above 50 million Danish crowns will also be required to have an audit or a review done by an auditor regardless of revenue and amount of employees. To avoid an audit requirement, other limited liability companies not considered high-risk companies must meet 2 out of 3 requirements during the first fiscal year of operation. The company must have a balanced sum of a maximum of 4 million Danish crowns, the sum of assets. The company must have a revenue of a maximum of 8 million Danish crowns, without VAT. And a company must have an average amount of a maximum of 12 full-time employees. A company cannot exceed 2 out of these 3 requirements during the last 2 consequent fiscal years if it wants to avoid an audit requirement. When you incorporate a new company, you can deselect the audit to avoid it in your first fiscal year by writing it into the Articles of Incorporation and Articles of Association. This had to be done actively. If you forget to deselect the audit, the company will be required to be audited regardless of the thresholds. So, it is always good to ask the lawyer or accountant helping you to incorporate the company if they remembered to deselect the audit requirement. If your limited liability company was established with an annual audit requirement, but the company doesn't exceed the threshold for having a mandatory audit, you can deselect the audit during your annual general meeting for the coming fiscal year. This is the meeting where you approve the annual report from the previous year. Special rules apply for holding companies that have a controlling amount of shares in other companies. A controlling amount of shares in the context of audit is defined as 20% ownership or more. If you have a holding company, the rules for avoiding the audit are initially the same as those that govern limited liability companies. But you must combine 100% of the values from all the companies the holding company owns shares in. Even if the holding company only owns 20%, you must add the total balance sum revenue and employees from all the companies where shares are held. We have reached the end of our discussion on Denmark's audit requirements for annual reports. It's essential for businesses of all sizes to understand these audit rules to stay compliant and ahead. Thank you for watching. My name is Anna. We are Dania Accounting.